Hi there, and thanks for joining again on another episode of Outside the Box. This is Terry Campbell with Johnson Insurance, and today I've got a guest that if you've been in the self-storage industry for any amount of time, you know who it is. It's a good friend of mine. We've done business together. We worked together. We got Bob Copper on today, and we're going to talk about several things that Bob is involved in on a daily basis, like feasibility studies, audits, due diligence studies, consulting, and things of that nature. But first, I'm going to ask Bob to give a little bit of his background in his own words.
Sure.
Bob, all you.
Yeah, usually my mom writes something out for me and I just read that, but I don't have it for today. But I've been in the stores business since the 90s. In fact, I tell people all the time, the only thing I regret about getting in the 90s, I get in the 80s, that I wasn't even in it longer. It was a business I figured out that I was just smart enough to do that, not too many other things. So we've enjoyed it. Started off working for Public Storage way back in the day and got a lot of good training from them and still have people there that I know, friends at Public Storage. And worked for a couple companies. And then back in early 2000, went business for myself. Our first grandchild was getting ready to be born, come along back in Birmingham, where we originally came from. And so moved back to Birmingham, and that particular grandson just graduated from college. That's how long we've been back now,
Wow.
back in Birmingham. And been doing it ever since. Started working with some guys doing feasibility studies, acquisition audits, and that type thing. And just kind of grew it into what really probably is now the largest consulting business in the industry that does that type of thing. And do it. We own a bunch of properties, as you know. We manage a bunch of properties, and so kind of all involved in that. It's a lot of family members involved. So it's been good to us, and we enjoy it, and really don't know what else we would do. Yeah.
Well, I don't think there's anybody in the country that does any more feasibility studies by far than you guys do. You do the most. And you mentioned Public Storage there for a second. They had a big day yesterday. I think their deal finalized in yesterday where they had bought NSA. So
Yep,
I think
I heard that finally got that settled up. Yeah.
big day for them.
Hopefully they'll have good success with it. I suspect they will.
I hope so. Well, let's start off just talking a little bit about due diligence and acquisition audits. Then we'll jump into some other stuff here shortly. Tell us what the due diligence and acquisition studies or audits actually cover. What do you guys look at? What do you cover? What are you sharing with the customer, and maybe some red flags that go along with that?
Sure. So yeah, specifically talking about acquisitions and those kind of things. So we do a lot of those. We do them for individuals buying existing facilities. We also do them for a lot of big companies. We'll do 4, 5, 6, or 10 at a time sometimes, because they usually need them for, independent third party to look at assets or looking at doing. And so we look at a couple of things when we do at an audit, and we're doing more of those, I would say, because right now, and I get the question a lot from people, what's the best way right now to get in the storage business? We hear that a lot. And then right now, I would say at 99% of the time when people ask that, it's to buy an existing facility. It's not to do development. Development is kind of challenging right now. It's always been challenging from the time it takes and all that. But I think if somebody wants to get in the storage business right now, that is the best way to get in it for now. And so that's why we do a lot of acquisition audits. No matter what size self-storage property you're buying, there's a lot of zeros at the end. And so a big investment for people. And so having someone kind of look under the hood, if for lack of a better word, like you would anything else, makes sense. Because if you get involved too much in a project, especially if you've not done it before, you can certainly miss things when it comes to auditing an existing facility. So we look at the physical part of it. We do a space audit, for example, make sure all the spaces are there and they're what they said they were. Because let's face it, we all look at a lot of offering memorandums that look at properties, and to be generous, they're not always as accurate as they could be. And so you want to make sure that if you're buying 300 units, there are 300 units there, and that they're, what kind of situation are they in? So we do a physical audit. We look at the property, of course, give a lot of photographic evidence to the owner, the potential buyer, I should say, of what they're going to run up against when they get there. We check leases, make sure that there are leases on the property and what do they look like. We do a cash audit, make sure the money's making it from the when people make a payment, it's all making it all the way to the bank. And then we, if they needed a financial audit, which includes checking bank statements and income statements and tax statements to make sure that's all flowing, that you're buying. Because at the end of the day, when you're buying a self-storage property, you're buying the income stream, and we want to help you confirm that in fact is what the income stream is, and that there aren't going to be any issues once you take it over. Now, you mentioned red flags, Terry. We've certainly ran into properties where, turns out the current owner had 50 or 60 friends and family units at big discounts. Well, we need to make sure we know about that, because more than likely when you buy it, they're all leaving. They're not going to stay, and you won't let them keep their $10 10 by 20. And so you got to make sure you've baked that in. You may have a substantial drop in occupancy that you didn't keep up with. We found units there, where the current people, the current managers in place were stealing from the owner. Well, we want to make sure if we find that that going in of how to address that. We want to make sure that if there's, it's one thing to have 50 unrentable units that just need to be cleaned out versus 50 unrentable units that all need a new door. And you got to make sure you know that. And so we go in there again as an independent third party. The example I use, and I think you've heard me tell this one before, if you were to come to my house in Birmingham tomorrow, where we've been for years, you would notice things I have quit noticing because I'm there all the time. Same thing in a self-storage audit. We're going to see things that you don't notice because we're just coming in for the first time, and we're going to see things. Again, we've done this hundreds and hundreds of times too, but to me, it's very risky for someone to buy an existing self-storage property if they've never done it before, and not have somebody take a look at it, at least in a cursory review. The other thing I would throw in there is, we never recommend buying a self-storage property in a vacuum. If I go buy a self-storage property and I just buy the property and have no idea what's going on around it, there may be a reason this person's selling. Maybe there's 15 more in the pipeline that are going to kill that market. Maybe the population's declining. Maybe there's a new road that just came in that nobody gets to the facility anymore. So you've got to know, we all love buying those diamonds in the rough, right? We all love buying the one that we know we could fix it up and really make it hum. And that's great, but you got to make sure that if it's not performing well, why is it not performing well? If it's things that you can control, that's good. If it's if they got a terrible website, maybe they don't have a website. Maybe it's poor management. A lot of things that you can fix. But if it's just the market itself, if you're buying a property that's 70% occupied and you think, man, I can get that to 90. Well, if the whole market's 70, you're not going to get it to 90. That's the market. So you got to make sure you know what your opportunities are to improve the value, which we all want to do, that there are things you can control and are things that are not out of your control. So that's, in an acquisition standpoint, that's what we're looking at if we do it. And even if people are doing their own cursory review, those are the things they should be looking for before they make that commitment to buy something.
And I'm sure you guys have seen one of the things in those studies that I used to see a lot when I was doing lending was that you see a facility that's never gotten maybe above 70% occupancy. When you get out there, you find a fourth of the facility are 5 by 10s.
Exactly.
You got to convert those over to a unit that rents.
You would not, it's funny you mention that. I've seen properties that have the unit mix was the problem. And the funny thing is, in most of those cases, it was an easy fix, but the current person didn't know to do that, didn't want to do it. It's amazing how easy to just take 2 10 by 10s and make a 10 by 20. In fact, we don't even take the walls out anymore. We just change it in the computer. So you're right. That sometimes it's unit mix issues. I've seen properties, Terry's, that had 9 by 10s, 10 by 10s, and 10 by 11s. They're all 10 by 10s, right? The lease is always saying approximate. And so we really can complicate things by making it difficult. If I go on a website and I got to scroll page after page of the 49 different sizes they have, that's obnoxious to me as a customer. So you can imagine somebody looking through that. Look, condense it, make it easy, make it the basic sizes, 4, 5, 6 sizes enough. If you still got all those odd sizes, you have them, but they don't need to all be listed. So we've seen that. And as a lender, you've seen probably everything we've seen too, is just screwy stuff that doesn't make sense. But again, the good thing is that I think most things that are related to underperformance are fixable. Some things are not, but most are. But again, if you're buying it, you got to know what the issues are so you know when you take over how to fix it. Yeah.
And to me, if I were buying that study, if I were having you guys do it, the two most important things for me is, number one, you're showing me where the value add opportunity is, and you're showing me other things that are issues that I can use to negotiate the price.
That's a great point. We have found those. We found one not long ago where the current owner is representing a certain income. Turns out they were adding the taxes. The is a state where you do sales tax. That's not an income. So they actually didn't renegotiate the price a little bit, because you said there's bringing in $1,000. No, it was bringing in $950 because there's taxes, and you were reporting as taxes. And then they reported on the expense side as a pass through. Sales taxes don't get reported at all on an income statement. So little things like that you got to pay attention to. You got to make sure that the credit card fees are being accounted for correctly. You got to make sure of all those things. The other thing we always caution people on is when you get an offering memorandum from a broker, there's only a couple of the expense side that you need to be particularly concerned about. Because like when we buy a property, we want to know what the property taxes were, what the property insurance was, and what the utilities are. The rest of the expenses, like the marketing, the repair and maintenance, and office expenses, are going to be what we want them to be and need them to be. But I do need to know those other ones. So sometimes people need to understand, if you buy a property that has a zero payroll, are you going to have a zero payroll? Because the current owner isn't paying himself, but you can't do that. So you got to make sure when you look at it, you analyze the numbers correctly, because again, this isn't like buying $25,000 homes and flipping them. These are bigger operations. They have more zeros involved. Again, I can't imagine doing anything that's better, but it is a bigger piece of real estate. So you have to make sure you don't miss some of those things.
Right. And you mentioned insurance. Obviously, I'm going to jump on that one because that's
sure.
My world now is, sometimes folks are buying these facilities that somebody's owned for decades sometimes. Yep. And number one, they don't have it insured fully, as far as replacement cost. And sometimes the insurance company they're with has been just giving them a deal forever because they've never had claims. But once that thing changes hands, I've seen it triple.
Sure.
There's some that I've invested in with you guys. We've seen it triple from what the owner was paying to what we paid.
Yeah.
So that's definitely something to look for. Is there anything?
Let me back on the insurance thing real quick. You mentioned this, but we've seen this happen where the current owner, because they either already own it, they don't own the bank, is not covering flood insurance.
Yep.
But a new buyer, if they get a mortgage, is going to have flood insurance sometimes. So make sure you know that, because their insurance might be a fourth of what you're going to have to pay because of that difference. If somebody's had a property for 20 years, they may have long since paid it off. And so most of us only have, let's face it, most of us have flood insurance because the bank makes us have flood insurance, not because we think we need it and that we want it. It's in place insurance. Well, you may have to have it when the other guy did. So make sure you've paid attention to that.
Yeah, it's a good point, because it's not cheap either.
It is not cheap.
Not cheap.
Yeah.
It's not.
And
cheap.
you don't have any choice.
That's right. That's right. You got a loan on it, you're going to have to do it.
If you don't get it, they'll put it in place, and you have to pay it. There's no way around it.
If it's forced,
their in place insurance is really expensive.
Yes.
Yeah.
Yes. Is there any one particular thing that you would have said was maybe a big surprise you found in an acquisition audit, due diligence audit? Is there anything that stands out that you found?
Yeah. In our case, we bought one ourselves. We have literally hundreds of portable storage units across all of our properties, box wells primarily.
Yep.
And in most of those cases, we added them to an existing facility after we bought it to expand the property. We love doing it that way because we can put one over there and one over there and one over there without having to pour a 10,000 square foot slab where maybe you can't do that. So we're big believers in them. We bought a property in Louisiana, and we asked the current owner, they already had some box wells out there. Oh yeah, those were approved. Okay, great. Well, so we buy it. Well, as part of getting our business license, they have to come out and re-inspect the property. They saw those box wells, said, where'd those come from? Well, they were here. Those aren't allowed. We actually had to move those ourselves to another property of ours because they would not let us keep those box wells there. So we made that mistake by not doing better due diligence, like making sure. So that leads to one of your things you should be checking in a in a due diligence package is were all the buildings on there permitted? And if it's a fairly new property and nice Class A, it's been permitted. But I've seen properties that got built in pieces over years, and
Yep.
I can tell you, not all those got a permit.
Yep.
And again, if you've got an existing property and I've had it for 20 years, and I decide to build another small building, I will probably get away with that. Let's face it, especially in a lot of secondary, tertiary markets. But as the
Yep.
new owner, if they have to come out and inspect it, I've seen people get dinged. Now, what typically happens is they don't make you tear the building down, but they do make you go through a process to
Yep.
get it permitted. And so you don't want, if you're buying a property, you want the onus on the seller to make sure everything's permitted, not you as the new owner. So that's been something we've seen. Again, we've seen, make sure we've seen people that did not have a good contract. And it turns out all that stuff you thought you were getting as part of the contract, it's not in there. Then you don't get to keep the golf cart. They're not even going to keep the insurance. They're not even going to keep the name. So make sure that you know exactly what you're buying, that the personal property is what you're buying, that it's there when you get back. Because I've seen people surprised because they just assumed the stuff they saw came with the deal, and it didn't. So make sure that, and I've seen people get crossways with partners and stuff because they didn't have a good partner agreement, and people got crossways on that. So,
Yep.
the great thing about storage is what I love about it, why we've been successful. It's a fairly simple premise, right? We build space and people put their stuff in there and they pay. If they don't, we get rid of them. I mean, it's not that complicated, but it does have some complications that you got to be aware of that can really make you crosswise. And that's some of the stuff that we find when we go through these projects with people, is to make sure you've done that stuff. Make sure you've got a good phase one, that you've done it. Because again, if the previous owner been there 20 years, never had to get one, well, you may have to, and you may find out that thing's sitting on an old gas station and the tanks are still in there, and the bank won't insure it. I've seen people couldn't get a bank loan because the phase one failed and you didn't. So you got to make sure of stuff like that, because again, you just can't assume because it's been sitting there for 20 years, there's nothing wrong. Maybe there's not, but you might have make sure. I think the biggest thing I've seen, Terry, though, that people have messed up on is they didn't do the financial audit is typically pretty straightforward. If you've got a good contract and they had to provide you 12 months of income statements, 12 months of tax, all the stuff they have to provide, and make sure they do provide it. I find more often than not people get messed up on the physical part. Again, not making sure that the units are what they were. To make sure that if it says they're all 10 by 10s, they were 10 by 10s. To make sure you knew what unrentable meant. Because again, people take it for granted that if it says there's 300 units there are, and they're all fine and ready to go. And that may not be true. We find that, I would say on most of our due diligence audits, we find more issues on the physical side than we ever do on the financial side.
I can see that. Well, let's switch gears a little bit. We'll talk about market and feasibility studies, but like you were saying, you're doing a lot of due diligence studies and acquisition studies because building has slowed down. I mean, there's no doubt buildings slowed down. People aren't moving like they were, and
Right.
interest rates are up, and just new stuff is being put on the shelf for right now. But let's talk about market and feasibility studies and talk about the difference. A lot of people get those confused and think
Right.
a market study is a feasibility study, but there's a difference.
Right. They are two different things. Right. That's a good point. And in our case, we do two different levels of studies, as you know, so people can ease into it and find out what they need to know before they commit to the next level. A market study is what it sounds like, which is a study of the market, the site itself, all the competition, the demographics. And basically that says, based on the market study, there is enough evidence here to say, yes, this project should move forward and it'd be a good project. And we're looking at things like the site itself, the market, the demographic report. We do some demand calculations. We look at all the competitors, recommend unit mix of rates, a stabilized income statement. We know in that study, because we've done thousands of those, of whether a project should move forward or it should not. In our case, a large percent of the studies we do at that level are negative. We know within that study the things why this isn't going to work. A feasibility study takes all that and fashions out a complete financial analysis that typically says it is financially feasible. Now we'll know in the desk study it's going to be financially feasible, but the full feasibility study, which is usually what a bank needs, right? That's how we got so involved with you as a lender. Is it's a financial package to say cash flows. Here's what kind of money it makes, and that's really what a bank or a lender is looking for, is it make financial sense. Now, we do the whole thing because we want the bank to be comfortable that we didn't just create a financial package. Here's all the proof of why it works. The market's good. The rates are good. Occupancies are good. There's growth in the market. There's a demand for climate and not non-climate. We want to document all that. But at the end of the day, as a lender, that's what they're wanting to do. It's interesting to me when I was doing a podcast the other day, as you know, and one of the questions that came back, what are one of the things that people get into dangerously? And I think my first one was listen to Facebook too much.
Yeah.
I mean, some of the stuff people say on Facebook, oh, you got people not paying their bill, just throw their crap in the dumpster. Really? You're just begging to get sued. Or you don't need a feasibility, just go out and do it yourself. That's great, except my bank needs a feasibility study. That's not helpful. And I've never done this before. I don't have any business figuring this out myself. Are there things you can do yourself? Of course, before you get to somebody like us. But by and large, you're going to want, again, none of us, we wouldn't, our homes, we get them inspected. We make sure, before we buy it, that it's right. Same thing in this thing. So if you're getting ready to do a new development, I think it's even more critical than on an acquisition to do a feasibility study, a market study at the minimum, just to make sure you have fallen in love with a site that really has no business being a self-storage property. And so, and all those reasons, I mean, people call us all the time and say, look, I've checked all the competitors and they're all full. That's great. What are the rental rates? I don't know. That matters. In fact, that matters more than the fact they're all full, because that's the number one reason we tell people not to build. The rates are too low. And you mentioned the market we're in now. We clearly are at a point where, occupancies in general are down, rates in general. If you look at any, we thankfully, because of our size, we subscribe to all those expensive databases like some people do. And all the charts, all the historical stuff shows a steady drop for like 21 and 22 where we are now. And so anybody who is basing their knowledge or their experience on 2021, 22, they're going to be sorely disappointed in where they are now. And so you have to make sure of where you're headed. Now, have we bottomed out on rates? I think probably. I think we're kind of leveling out. And you hit on the exact right thing, which is we need people to start moving again. That's the main dynamic of why people use storage, right? And so right now with interest rates they're either too high for people to move, or they have a too low of an interest rate to move. They're locked in where they are, where they don't move. Yep. We got to have that breakout. And so if interest rates were to drop some, I think that would help. Right now the cost of developing is, it's not at its peak at high. It's come back down. So the cost of developing isn't terrible. But if the numbers don't work on that side, the old days of, I remember years ago, we used to figure out facilities that all lease up 4% a month until they've filled up. Well, that's just not true anymore. Sometimes they take forever to lease up. Sometimes they never lease up because they're too big or whatever. And so I think for most people now, unless they find the perfect place, it's very difficult to do a development right now. And you hit on, somebody said, like in one of the databases that we use, it has like all these dots of all the country, of all the developers in the pipeline. I heard people say as many as 80% of those will never get built because they started down the process and the market's changed. It's dropped, and now the numbers don't make sense. They realize it's going to take 2 years to get through planning and zoning. And so why do it? And so I think that's where we are. And again, in our case, we certainly buy more than we build. We still build occasionally, but buying is really, in our opinion, where most people should go. But the main thing people get messed up on feasibility studies is not understanding the economic side of it, which is the rental rates. If the basic 10 by 10 is $40 in your market, you're not going to get $120. You might get 50 because you're new, and you can't. If the land's free, you can't do it at $50 10 by 10. Yep. So, we got to just make sure of how that works. And then you throw in the land value, and people don't understand that. And so it's a more complicated process. it's certainly easier to get in the storage business do acquisitions simply from a lending standpoint. Again, that's your background. If you think about lending, if I'm buying an existing facility, a lot of what you're lending me is based on the acquisition of that facility. If I'm building a new one, it's based on me. It's my ability to pay that loan back if the facility can't. So it's so much easier for people to get into the business that way. And they still got to have obviously some credit and some equity, but I don't think it's nearly as difficult to get an acquisition done as a new development because of, I mean, it's not unusual for a project to take 2 years from I want to build it to you rent your first space. And in the meantime, the bills never stop. And so keeping up with, I was talking to somebody the other day about a project and they had a budget, and the one big line item, Terry, they forgot to budget was negative operating capital. And it was going to be, and so we did the calculation, it was going to be almost $2 million because it's a big property. They hadn't counted on that. I said, well, somebody's got to pay that. And that, so, again, these Facebook things, oh, you can throw one up for $20 a foot. No, you can't. You can't. Maybe some plywood that you buy at Home Depot, you throw it up, but that's not what that is. And so I think people have to keep in mind that there's enough bad information out there. Just be careful. I had a guy I did a study on the other day. He sent me back his expected expenses, and you'll laugh at this one. It was a 45,000 square foot facility, which is a nice, moderate size, nothing wrong with it. He said, based on what he found out from Facebook and stuff, that he sent me back a $175,000 a year payroll, $100,000 a year utilities. I said, I've been doing this for 30 years. I've never seen those expenses that high. He just took some stuff he got up from people off Facebook and I said, that was your first mistake, that just doesn't make sense. So anyway, you just got to be careful about, are there people out there on social media that know what they're doing? Of course there are, but you got to be a little discerning. If it sounds too good to be true, it probably is.
Yep.
And just pay attention and, join your state association, get that education. Good point. I still think of everything out there in commercial real estate. You think about everything else that's out there. This is still the best one to be in. I'd hate to be in office space right now.
Oh yeah.
People that call us want to convert their office space to self-storage because nobody rents the offices anymore. Retail is struggling in a lot of places, a lot of empty spaces. So I think it's still the best place to be. But right now it's a little bit of but now if you look at, we were doing this the other day, if you look at the graphs, that spiked up in 2021 and now they're back down. Over here, they're kind of what they were over here. It's just that middle jumped up and now we're back. I wouldn't say we're back to normal, but not too far off from normal. And so, when we just got to be careful about that, about make sure the numbers, because at the end of the day, you don't want to go through all that trouble and not get a bank loan because you didn't know what the numbers should be.
Yep. All the COVID stuff caused an anomaly in our industry for a while.
Yeah,
popped up and went away. And thank goodness, in a way, it went away. You mentioned something.
Well, real quick, in general about the insurance side, what have you seen that on a percentage standpoint increase? Has that been one of our biggest increases in operating expenses has been insurance, wouldn't you say?
Oh, yeah. Yeah, for sure. In the last 3 years or so, it's definitely been that and taxes, depending on where you're at.
Right.
Insurance has definitely gone up, and the insurance, it's leveling off now.
Okay.
So that's a good thing. Hopefully, it levels off and kind of stays there. And hopefully this year, the hurricane season is like it was last year. We didn't have one last year.
Didn't have one. That's right. Mm-hmm.
Which was very helpful. So, if natural disasters this year can stay low, maybe hopefully, it levels off some or goes down some.
Right.
Future. But, I've said this before that one of the reasons that insurance costs went up so much was because, like in the banking industry, you've got to have a certain amount of cash reserves on hand.
Right.
The insurance industry does as well. Well, with all those natural disasters, fires, hurricanes, flood, all the stuff that was going on, they were depleting those cash reserves. There's only one way that they can increase those cash reserves to what the government requires, and that's through premiums.
Right.
So that's why it's gone up. So, but it's gotten better. And like I said, if there's less payouts coming, and if we have another decent year as far as weather and things like that, maybe it'll come down a little bit.
Right.
But it's like it used to be when I was in the building business. Steel would go up like a rocket and come down like a feather.
Right.
So
Right.
you
Right.
don't expect
Kind of like gas prices, right?
Exactly. And, the cost per square foot, a lot of folks have been underinsured for several years. And some of the carriers now have a minimum amount. Like there's some carriers that require at least $45 a square foot replacement cost for a drive up non-climate single story.
Holy moly. I
So
mean, that
you've
seems
got
high
that.
to me, but it is what it is, right?
And one of the ways they look at it is, what have they paid out in claims? And
Sure.
they look at that like, on the panhandle of Florida. If there's a major event like Michael was back in 2018 or whatever that
Right.
was,
Right.
okay, you're going to have a massive labor shortage. You're going to have a massive material shortage. So the prices are going to go up. And that's what they look at. If there's a catastrophic event, $45 a square foot might not even cover it
Right.
because of those factors. So, but yeah, hopefully this year the weather is good again. And I saw there's one down in the Gulf right now, but it's not expected to become much at all. I think they're
It's been a tropical storm. We've gotten some stuff down in the Panhandle, Panama City, where we got some properties, but really nothing. Most stuff down there is built to such high hurricane standards now
yes,
that
yes.
it takes a lot more than a tropical storm to do much damage down there anymore, which is good.
Yeah. And they're actually forecasting for the Atlantic to be somewhat quiet, but the Pacific is uncharacteristically been a little busy.
Interesting.
So who knows? But hopefully in the long run, that's it. Now, as far as new stuff, feasibility studies, people coming to you, have you had a noticeable drop in the requests for feasibility studies for new stuff?
Yeah, we have. Like I said, we've had more uptick in acquisition interest, but feasibility studies in general. Now, again, been doing it almost 30 years. That comes and goes all the time. And so, but I think right now, because of where we are, it's more because it is more difficult to make project work. More people are not. I mean, and one thing that's been good about social media and how easy it is for everybody to access. Anybody looking at maybe getting into this can guide you a little research of their own and for like, wait a minute, this might not be the best time to do a new development. And so, yeah, I think it's dropped up. I've talked to some other people that you know well that do what I do, and same thing. It's just we've all seen a big drop. Again, it's steady, but it's certainly not what it's been, over the years time, and it could roar right back next year. Who knows? But and again, that's a natural ebb and flow of. You've talked to any of the banks; they're getting less. Less people. They're still getting a lot of people wanting to buy, but as far as new facilities, I think that's dropped off some. I talk to builders on a regular basis. Same thing. I haven't talked to a builder in a while that hasn't seen a slowdown. Again, nothing dramatic, but certainly not what it has been. A lot of the builders that I've talked to, they're staying steady because there's been an uptick in flex space instead of self-storage. So, and we've seen the same thing where we now do feasibility studies and market studies for flex space because we've seen that tick up. The banks have asked us to do that specifically. So that's picking up, which is just the small bay warehouses that people are doing more and more of. So yeah, it's steady, but it's certainly not what it could be or has been. And, that's normal. That's pretty natural right now.
Yeah. And you just kind of segued into what I was about to mention next, and that was flex space, because I have seen a lot of people, self-storage folks, that have kind of pivoted because of the reasons we've been talking about. The occupancy is down because people aren't moving, rates are down, so they've been pivoting to flex space. A lot of them are doing pure flex space sites. Some are adding some in with self-storage.
Sure. We've seen both. Yeah.
It's good to know that you guys are doing the feasibility studies for that. I didn't know that because we do insure a fair amount of flex space. Yeah. We've been doing several
of those.
I
think why we're seeing that grow is that, yes, while self-storage in general is slower because people aren't moving and all that. Well, one of the pillars of self-storage is commercial. And so, and that still stays pretty, because, you know, you know, despite what you might hear, the economy's pretty decent.
Yeah.
Unemployment's pretty low. And
Right.
so people are starting a business. We also own some small flex office space here in Birmingham. And a young lady called yesterday. Said, look, I got a floral business in my home, but it's growing. I can get out of my house. I need it. I need to move into a bigger office space. I think that's happening with the flex space, where more and more people they've been maybe trying to run a business from home and run it on their cocktail table at home, and they want to branch out. But what flex space does, it gives them the flexibility to dabble in or go out and try one without tying up and buying their own warehouse, tying up, getting stuck with a 3-year lease they might not be comfortable with. And so it's taking some of the advantages of self-storage, the flexibility and not being tied up forever, and giving people that option to grow into 1,000 or 2,000 square foot office slash warehouse space. And so we're seeing it. So yeah, I think it's got a lot of legs, and it's almost, I would say it's infancy, but it's got some more room to grow. The other thing is you can build, it can be financially viable without having to build 1,000 of them. You can build 20 of them.
Right.
And have a good start. So we're seeing that more. You're seeing it more. The banks are seeing it more. So I think that'll be continue to rise. We also do still see a good amount of boat and RV parking studies.
Yeah.
I would say in most markets we do studies in, where self-storage is still might be oversupplied and still struggling. Boat and RV is almost always undersupplied. It's not as big a business. It's a lot more fractured. There's not like big REITs that own all of it. It's very mom and popish, more so than self-storage is. Makes it a little more problematic to do studies on it, because half the time nobody answers the telephone, but it is different. But what's nice about that is, during COVID, there were more boats and RVs sold than ever in the history. Well, those people need them, put them somewhere. And so HOAs don't allow them to be parked there. So is still, if somebody were coming to me and say, look, I want to get into this somehow, I'd say, well, then buy some acreage and put boat and RV parking up for now, and put a fence around it and a gate and be in business. And then you can always add storage to it as you grow. But that's a pretty inexpensive, quick way to get in storage in most markets where there is a demand for that.
Yeah. And that's a good point, because we insure, a fair amount of boat and RV storage, and I'm on the advisory board with Toy Storage Nation, and
Okay,
I
good.
see, and usually in our meetings, they share with us the number of units that have been delivered out there of RVs and boats. And it's still unbelievable.
It's
The
still
number
unbelievable.
that are going. We kind of do a little math. We back into, okay, there's this many new units. Let's say only a percentage of them need to be stored they all got to be stored somewhere.
Oh yeah,
but
sure.
let's say only a percentage, and there needs to be X number of new storage facilities for these things built out there. So that there's an opportunity there for sure in a lot of places.
Yeah. If somebody said, if I had to pick one and could get into one, that's what I'd probably lean them towards, to get started, at least until the self-storage piece picks up over time. Yeah, I agree. And it's also a great add-on. It's pretty normal for us to do a feasibility study for somebody on a self-storage property. And look, you got an extra 2 acres. Let's put 50 out there. It's minimal cost. Your insurance premium isn't going to go up any if you put a bunch of boat and RV park out there that aren't covered or fully enclosed. And so why not? So yeah, I think that's still got legs too. I think between that and flex space, those are more growth in the next couple of years than self-storage probably.
Yeah, I agree. Well, Bob, I do appreciate you being on here.
Of course.
It's been great, and catching up with you and having this conversation. It's always good talking with you. You're like family as far as I'm concerned, and I always love to have a conversation like this. So, thanks again for joining us, and everybody. Hope you enjoy this episode, and look forward to seeing you on the next episode of Outside the Box.